And to wrap up our session on risk, our next speaker is Andrew Trotter, the CEO and founder of Lativo International. Andrew is a farmer. He's the founder and CEO of Lativo and responsible for creating Australia's first revenue insurance program for farmers. He manages a 1,000-hectare farm with his father in the Wimmera district, and previously worked as a senior agronomist and product development manager with New Farm in southern New South Wales and an ag chem business in Grenfell. After gaining his degree, he went to work for the University of Saskatoon, where he developed strong links in the Canadian agriculture sector. This has since enabled him to develop the revenue protection product he's now responsible for in Australia, which is modelled on a comparable Canadian program that has been successfully operating over the past 4 years to support improved farm management and profitability. So to talk to us about revenue protection, revenue insurance and reducing some of those risks we've been talking about, Andrew Trotter is our next speaker.
Thanks, Mick. Obviously, as you would have heard, I've had a rich and diverse background in Australian agriculture and fortunate enough to have quite a bit of time in Canada as well. 4 years ago, I embarked on a project that everyone said couldn't be done, which was to bring to Australia a risk mitigation product that would enable farmers to basically hit a reset button. We have so much volatility and variability in our climate that it's absolutely impossible for us as farmers to mitigate that risk on an annual basis through our management techniques. We needed another solution. So when we went and attempted to introduce this to Australia, the first thing was those headline numbers that we saw earlier come up. Rain-fed farming in Australia is not only part of one of the riskiest agricultural pursuits in the world, it is the riskiest segment or the most volatile segment of it. So the doors were closed, a bit like the doors are closed to the superannuation industry. Because if you think it's hard to convince the superannuation industry to invest in agriculture, try convince the insurance actuaries of the global insurance world to write the checks out when everything goes bad. So it was really simple. We had to find another way. Australia to the insurance world just would not work. So we're fortunate enough, there's a lot of history in the Canadian market and a product over there managed and initiated by a man by the name of Clark Colson that was able to get it up and operating without the assistance of government funding. And that's exactly what we needed here. So over the last 4 years, we've completed our modelling and got the confidence of the insurance actuaries and been able to commercially launch a product here in Australia. So a lot of the background's already been covered off, but one of the things I'd like us to all think about is to lower our eyes a little bit. We've all been talking about headline numbers, agriculture as a whole, as an industry, as sectors. I'd like you to think about this at the individual farm gate level, because the single biggest thing that we've got is there's been massive change in the last 7 years across Australian farming. Effectively, we've now got Australian farmers with the most debt that they've ever had. With the most debt, it means that we have significant interest costs and we have a challenge to repay that. What's happened is most farmers, particularly since about 2005, have chased the expansion or more farm area to improve their trade terms because they weren't making enough profit. So they thought scale was going to deliver that to them. In the process of increasing that scale, they've also increased the risk and the working capital requirements of their business, such that when we have a poor season, the downside risk potential is greater than ever before. And it is this downside risk potential, which I just highlight here, that is what's stopping people further investing in agriculture and having the confidence to actually run their businesses the way that they want to run. Because if they lose that capital investment in their working capital, they no longer have the capacity to keep going. We have two real risks in terms of our capital in Australian agriculture. Land prices now are basically the highest they've ever been, and in some areas they're actually falling. So we have a situation where you have the ability to lose capital in your fixed asset, but you also have the ability to lose your working capital. And we all know, we saw those numbers, 2002, In WA 2010, it had some catastrophic seasons. And what we need to be able to do is manage the precautionary and the catastrophic risk in our individual business, because the single biggest risk is your 5,000 acres, not the whole districts, it's your 5,000. And this is why insurance works so well, because like on our farm at Rapanyup in Victoria, we could get hit by a black frost this October and be wiped out. Yet everybody else around Australia have a good season. But that could cost us $1.5 million. That's the reason why insurance works. You have to be able to spread the risk, not just across Australia, because as you saw with the numbers, Australia can't sustain an insurance product in-house. The risk profile has to be laid off to the global insurers, and I'll go through that in a minute. Basically covered that. The number one point here is that if you look at most businesses, and this is a really scaring analysis that we've completed in this process, somewhere on the order of 40% of the businesses cannot handle a known worst case scenario in their district and stay within bank covenants. They end up in the bad bank, as we call it. So it's a really significant risk that farmers need to mitigate. Their cropping enterprises in the chase of profitability has expanded at a rate that they cannot swallow that downside on their balance sheet. And there's plenty of bankers in the room here, and you know exactly what I'm talking about. So we had to go about it a different way, which is insurance. So effectively, the way that we were able to unpick all this is that unlike all the other models that you've seen around the world, you cannot have a mandated product. You have to be able to individually assess, because from farmer to farmer, the difference is mind-blowing in terms of their profitability. We assess farmers on their ability to farm, which is effectively turn moisture into dollars. To do that, you first have to turn it into grain, then you have to sell it. So that's what we look at in our assessment criteria. As you can see there, it's individually assessed. It's not based on yields. It is customised to the individual, and that's what makes this work. There's a lot of flexibility in the model, which I'll go through, so it gives people the ability to tailor what risk profile they want depending on the strength of their balance sheet. So effectively, I've already mentioned that point. So what we wanted to be able to do, and this is the entire aim of the program, is to remove that financial risk, give growers a tool so that they can take that downside risk out of their business and make everybody in the farm comfortable. And that's mum, dad, the wife. I mean, everyone in the room would know who's got their own farm. The thought process of not being able to go broke is pretty nice, isn't it? You can actually put your hand on the heart and say to the kids, the farm will be here for you in 20 years' time, because I'm not going to go broke. You actually have that choice now. Before Lativo was here, you never had that choice. So it puts so much comfort back into farming that you actually can make the right management decisions. So I'll take the time now to just go through the details, which all of you will need to understand, of actually how this works and the flexibility it gives us. So firstly, how do we know that Lativo and its partners can sustain a disastrous 2002? Like you see here, Lativo is a managing general agent of Allianz. Lativo takes no risk whatsoever. It's all backed off to Allianz. We all know Allianz is one of the world's largest financial institutions, but our contracts are with Allianz Australia. So Allianz Australia takes a very small part of the risk as the fronter of the program. The big money is laid off behind it to Allianz Re, Swiss Re, Partner Re, and a swag of other global reinsurers. And that's what makes this work. That we have the financial capacity behind the business to not only make those payouts in those catastrophic years, but to actually grow this program such that more farmers in Australia can mitigate their risk profiles. So what do we do when we're getting people into the program? We go through an intensive risk assessment. A little bit more detailed than what obviously the banks do, because at the end of the day, when something goes wrong, we're writing the check out. So firstly, we look at a minimum of 5 years of financial records. So we have to go back to your tax returns, we have to reconstruct the numbers to facilitate grain that's been sold sometimes 1 or 2 years into the future, add back grain fed to livestock so we can accurately calculate how much revenue was made on a per hectare basis in the last 5 years. So that gives us a historical perspective of the business. But that wasn't even enough for the global reinsurers. So yes, that's what you've done before, but what controls do we have of how the farmer's going to operate this year? So we take into consideration the agronomic plan. So if you put a plan in place, at least we've got an idea you're going to follow it within reason. And the same goes with the grain marketing plan. Now, one of the reasons why these were put forward, it actually really wasn't for the insurers. We actually put these two things in to protect the farmers. Because we all know what happened with the insurers in the Queensland floods, didn't we? Some insurers paid out, some didn't. So the last thing that Lativo was going to do was allow that sort of scenario to happen or pressure from any of the global reinsurers. So when we bind a policy, the policy is bound in consideration of your agronomic and your farm plan. That leaves no hook for the insurers to get off because they've actually agreed with what you're going to do. Very subtle but very significant point in the insurance world. So how does it work? It's really simple. You qualify for $1 per hectare, multiply it by your hectares. So in this situation, let's just assume you qualify for $500 a hectare. You had 2,000 hectares. So you've now got $1 million contract with Allianz. So if you look at the good year, without insurance, you're hoping to make maybe 1.4 million. That'd be a reasonable return over your $1 million investment. The problem is you have a downside, and we'll go through this a bit more, of down to 400,000 because it didn't rain and you had a poor spring. The concept of insurance is simply that you take out a policy. Now, depending on your risk profile, it's going to cost you somewhere between $45,000 and $80,000 to buy that insurance premium. But the vast majority of that is offset within savings within the business. I'll talk more about that shortly. But effectively, like that orange bar is, if this year came in and you only made $400,000, you'd submit your claim and you get a cheque of $600,000, topping yourself back up to that $1 million, replacing your working capital, so that you can then go ahead and farm next year without the financial pressure of having to go back to your financier and trying to get money. That's the aim of it. It takes that stress away. So the way we do it is that the product is built in bands. So you'll see this is 8 bands. It can be 10. We haven't insured anyone up to $1,000 a hectare yet. So every $100 band per hectare is priced. Now, depending on what you qualify for, you can drop bands from the bottom or the top. So, for example, if we're moving from the top, say we qualified for $600 a hectare, but my costs of running my business was only $500. I could drop that $500 to $600 band to save premium and just protect myself from $500 a hectare to zero. If you're qualified for $500 a hectare, you also have the option of dropping the 0 to 100 and the $100 to $200 band. Because the probability of you're qualifying for $500 a hectare of not making $200 a hectare is really low. So we give people that choice. Some people still wish to purchase it, but it's an ability to actually reduce your premium cost. So that's the flexibility that we've got in the program. So one of the things that came out of our 4-year study, I should say, of pulling this together, was to really try help farmers work out how much insurance should they be thinking about. And it was a real sort of tough question because some people want to insure for a lot of right up to their high variable, their full business cost. Some farmers only want to insure for their variable cost. But how do we give a guide? So we calculated this little matrix called the Farm Sustainability Index. It's a very, very simple one. Can everyone see that? But I'll explain it really simply. Effectively, you work out what your worst case scenario has been in the last 10 to 15 years on a tonne per hectare basis, multiply it by basically $330 a tonne, add in any off-farm income that you know is guaranteed, and divide it by your production costs. This is a real-life example. And without insurance, this farmer has an FSI of 23.6. What does that mean? If it costs him $1 million, his worst-case scenario is basically $236,000. If he had insurance, he'd be at $840,000. So you can see the drastic difference this has for this farmer. Given that he's got no space on his balance sheet because he's expanded and he's currently at 50% equity, he was an avid buyer of the program this year. This comes from the Warwick-Nabil district. So I can give anybody more information about that one. So what we've found, even with the clients that we've got in this season, it has changed the way that they farm. Some people were able to farm fearlessly because they already had enough strength in their balance sheet, but others didn't. So they'd hold back because they didn't have enough planting moisture, or they wouldn't put enough fertiliser on, or they had a different grain marketing strategy. So the key of the insurance, in our opinion, is that there is 3 things to look at. There's the catastrophic loss that actually occurs, then, which is the sheer dollars that you lose in that production year. There's the aftershock, which is the funding cost of actually replacing that in your business. And there is the lost opportunity. So I'll quickly go through this, but this is a real case in Western Australia. A $486,000 payout would have netted this grower a $3.7 million return because he lost the capacity to hold the extra 4,000 hectares he had. He had to refinance the debt. And effectively, he's basically on the edge of insolvency, whereas if he'd had the policy back in 2008, factoring it all the way through, he'd have no debt, he'd have no interest, and he'd have money in the bank. And if you want more details about this case study, you can see it on our website. So just a quick summary of what we've achieved so far this year. So that's our geographic spread. So for all of you in risk profile, as much as we'd like to take credit for planning it that way, a fair bit of good luck to get that degree of risk profile across Australia. So that's 124 customers that we've got in. It's a really interesting correlation. So what farmers actually came into the program? The number 1 correlation is off-farm education. Those farmers that have actually worked in the industry and understand risk are straight into the program. And they're leading taking these programs up around Australia. So effectively, we've now got a product that's sustainable in the Australian market without government subsidies. There's plenty of people are watching, and when we make some payouts at the end of this year, because there'll be somebody in Australia that's in peril, everyone will know that it's real and tangible. Where are we positioned now? We're potentially poised for exponential growth within the Australian industry. And we're happy to work and help with you to work with any of your clientele to introduce them to this concept. Because ultimately, it just makes farming a lot safer and enjoyable for the people involved when they can't go backwards. So to sum up, our philosophy is mitigate the downside risk in your farming, in the financial side of your business, and get on with farming. Thank you.